Hello everyone, a very good morning, good afternoon and good evening to all. Myself Vaibhav. In today's session of automated trading, we are continuing to work with the system which we have developed in last two trading sessions. This is basically a combination of the EMA envelope with Williams R, and to further optimize our entry and exit points, we are also using the min-max and the ATR system. I hope you are well familiar with the functionalities of the indicators which we are using in our session. So there is min-max, ATR, and here is the standard disclaimer. I would like to remind that this is simply a tutorial session to help you build an efficient algorithm, and no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. Suppose if any of you want to use any of the algorithms, I would recommend that you do enough of trial runs and also allow it to run for sufficient enough time on the demo accounts to get a clear-cut idea of the efficiency of the algorithms. And of course, nothing in the webinar is to be constructed as an advice to trade or for any particular setup. On that note, we start for the day. Here this is a brief synopsis of the setup so far. We want our trades to happen only during the initial trend change. So what we are doing, we are mapping the overbought and oversold conditions using the Williams R, and for that we will be comparing the current value of the Williams R with the value a day back using the shift 6 on the 4 hourly time frame. And also we are using this combination of the EMA envelope, and when the EMA envelope is changing the direction from being in the bearish territory to bullish, we will be looking for a buying opportunity, and when the conditions have been oversold for a while and now the trend change is happening from being in the bullish territory to bearish, we will be looking for a sell trade. And for that we are also bringing in the min-max conditions for our entry and exit points, and we will be utilizing the calculation expression to get the entry at opportune time when there has been enough of consolidation after the price move. So we now go back to building our setup on the JForex system. So this is the setup so far. Here is the standard instrument subscription. We are using the USD JPY, and the position amount has been defined at 0. The EMA envelope blocks on the 4 hourly time frame, we are using the default time period of the 14. Then the Williams R to help us define the overbought and oversold conditions. Min-max conditions of to get the highest and the lowest values for the last 12 hours, and then using those values and the ATR range, we will be trying to get optimum entry and exit points. The min-max conditions to just make sure that there has not been undue volatile moves just prior to the execution of the trades. So we are bringing in the shift 3. Then again the min-max conditions to compare the current values to the values 2 hours back, another precautionary measure, and the ATR, and then comes the we have defined this at 20% of the ATR. We will be adding it to the minima for a buy trade, and we will be subtracting this value from the maxima for the sell trade. And then these are the 10-second historical candle, shift 1 and shift 2. For immediate execution purpose, we are simply going on a market open. So now we go back to building the next level. Today we will try to complete, hopefully we will be able to do that in time, the buy side, and then if the time permits we will also work on the sales side. So let's start building. We will need to bring in the if blocks, let us take couple of blocks here. Now we want first to check whether the EMA bands are falling or rising. For a buy trade, we need the current value of the high band and the low band to be higher than the value a day back. So this is the shift 6 on the 4 hourly time period, and if you multiply 4 by 6 we get 24 hours. So that's it. Now we go to comparing it, the lower band to the lower band, and higher band to the higher band. Since we are buying, we want the higher band to be greater than the prior higher band. So this is it, and then we want the lower band to be also greater than the prior lower band. So that's it. Now we need the Williams-R conditions. The current Williams-R value should be greater than the prior Williams-R value. And then we also need to check for the oversold and overbought conditions. So here I will show you. Now if the buy trade is going to happen, we want the current value uh, to be greater than the prior value. That is one thing, and we also want the value a day back, that is 6 candle periods back, to be less than minus 70. So we are using the 70 and 30 combination. So for the oversold requirement, we will need the value of the Williams-R to be above minus 30, and for the for the oversold condition we will need the value to be below minus 70, and for a overbought condition we will need the value to be above minus 30. So that is our requirement. So now we take another if condition. So here we take the Williams-R of okay, we got it. Now we need to define it at minus 70. be greater than minus 70. So that is the requirement, and we want the current Williams R value to be greater than the prior value, so that's it. And we also want the yesterday's value of the Williams R to be less than minus 70. So here it should have been in a oversold territory. Now the trend change is happening. So earlier it was in a oversold territory. Again, let us go back on chart. So here is the condition. Earlier it was in the oversold territory. Now whenever the trend change will happen, when the price momentum will pick up and the current Williams R will be greater than the value a day back, we will look for a fresh trading opportunity. Coming to the setup, we have defined these conditions. Now let us add to the buy side. We will leave some space here just to make sure that if we need to add further conditions, we will have enough of space over there. We will need to bring in the multiple battery low. Okay, and component trading, we want multiple action. So here is, we will keep the multiple action here. We just don't connect, we will keep it as it is somewhere here. We will connect it later on. Now so we have defined these two basic conditions of the Williams R and the EMA envelope. Now we need to work with the min-max levels, and as I said, we have to make sure that there is no undue volatility just prior to the execution of the trade. And to fulfill that requirement, we will check for the min-max values. So we want the current minimum value to be equals to or greater than, it should not be less than, equals to or greater than the minimum value towards back of last 12 hours. So we take the bid side low price minima. This is 5 minutes. We need this one. Ask side, we want bid side. Okay, we got it. So we compare the minima 18. We compare the minima 18 to the bid and the low price to the minimum 26, and it should be greater than or equals to. So we bring in another block, and now we add this condition. It should be greater or equals to. Okay, now we check for the 5 minutes conditions, and the 5-minute requirement is that here also we want the last hours means current hours minimum value to be greater than or equals to the value 15 minutes back of the 1 hour. So again we take the current minimum value of the low price on the bid side. So this is it, the current minima 20, and we compare it to the minima shift 3 of the bid side low value. This is it. Okay, we got it. This same requirement again, it should be greater or equal than. So we take this and we add it. It should be greater or equal. So far so good. Now we need to work with some of our calculation to define the entry and the stop losses and the targets. We have roughly gotten the requirements using the indicators. Suppose if you feel I am missing out on something, you can simply remind me, as I hope that you are now well aware of the idea we are working on. So this is we have utilized the max values. The ATR will now be used, and we need to bring in the mathematical expression, mathematical components, and we define a buy entry price, and let me check if we have got the EP and the EPO value right. 0.2. okay, so we're gonna take the current minimum value of last 12 hours. So we go here to bring in and the current minimum of the bid side low price is minimum 20. We add yesterday's this result, the 20% of the ATR. So this is our buy entry price. We will want the execution to happen when the price starts to rise above the level which is about 20% of the ATR from the minima of last 12 hours. So that is our requirement. We do A1 plus A2 and we write it, we save it as BE by execution. Alright, okay. So here we have done this. Similarly, while adding the sale side, we will also need to calculate the sale execution. Now we first bring in the if conditions. We want the prior value, so this is shift 1, that means last candle of the 10 seconds, and this is shift 2 means the prior candle to the shift 1. So we will want the candle 30's closing to have happened below the buy execution price, and then the candle 29's close should be above. That will mean that the price is starting to rise above our desired entry point. And so we go to the auto created variable. Let me check if we have got, okay, we got this candle 19, 29 and candle 30. We take the candle 30's close. All right, we have candle 30's close, and it should be above, sorry, it should have been below the buy execution price. And we take another if block, info logical. Okay, so we have got this. Now we want candle 29's close. We are done with the 30. We want candle 29's close to be above the buy execution price. So, and is going to be connected to the market open. So I hope you have now fairly got the idea of what we are doing here. Candle close of the 30 should be less, and then it should be greater. Now we have defined the requirements. We need to bring in the market open, but as has been the practice so far in last couple of algorithms, we will again keep the target price and the stop loss price dynamic, just to make sure that we are well aware of the underlying instruments volatility, rather than going for a fixed target or stop loss. And as and when times keep changing, sometimes the particular instrument is damn volatile, sometimes it is pretty calm. So we want the trading to happen taking in mind those situations, and just to make sure that's the case, we will keep our stop loss target dynamic. So now open at market execution will happen. There is no pending order, so we don't have to define order validity or other requirements. So this is, we want candle close to be above the by execution. It will be a buy trade, so we are good here. Use the JPY. Trade amount, we will keep it at 0.1 million. You can change it to any extent. Slippage will be 2 pips. And now comes the stop loss and the take profit condition. You can, if you want, even I think this setup is itself complete in its own right. If you want to go with a fixed stop loss and the target, you can simply define the stop loss and target prices here. Now currently default value is 25, target is 50. You can write any value, 20. You can keep a combination of, say, stop loss of 10 pips and target price of 20 pips, any combination, it's up to you. But now for our purpose we are making it dynamic, so we bring in calculation expression, and then we define the range using the ATR. So now we take the calculation expression, we will cut it out, both these default values. Okay, let me take these if conditions back to where they belong. So here, now coming to the calculations for the uh, we are going to use a combination which should be good enough depending considering the fact that we are working with a algorithm with the 4-hourly time frame, so we will need to keep the stop losses and the target accordingly. And as you can see, there is this 20% gap here, and I think whatever be the days ATR, we need to keep at least half a percentage point of the sorry, the 50% of the average true range. So in that scenario, we can simply go with a combination of say 50% of the ATR for the stop loss and say 100 or 110% after adjusting for the brokerage and commission, etc. So we can keep a 110% of the ATR for the target, and it will give us a risk reward ratio of 1 is to 2. So we go with that combination. So first we will need to define the 50% and the 110% of the ATR value. So we need to take the ATR into consideration. We have line 27, this is our ATR. We multiply it, we create a new variable, and the new variable's name will be, you can suggest if you want, oof, let us say SLE, sell execution, stop loss execution, SLE, and 0.5. Okay. Now comes the time to multiply the ATR by A1 into A2, and this will be our stop loss, and we want to do the type conversion as well. We will have to convert this double into integer type, and this is the Java setup. The underlying language is Java, so we have to use that. And here is one interesting thing we have to now suppose first I will explain to you on this. You might have noticed that here the stop loss and the take profit, it is in integer setup, and the values are like starting from 1 to 100 or whatever. And now the ATR range is defined in 1.2 or 0.5, 0.6, and it is using the double format. And here we are basically concerned with these pips, so for us in integer this become 85 pips, but for the ATR it becomes 0.85. so we have to do type conversion, and for that we will multiply the 0.85 into 100 and we will get the 85 pips. So similar idea we will adopt here. So whatever is the 50% of the area, we will multiply it by 100, as this is in a 2 decimal point setup. We have these pips after 2 decimal points, so we have to multiply it by 100. So we create a new variable, type conversion tc, and it will be 100. Okay, so we go for it and we do again multiplication a3. So now we create stop loss price slp, and we haven't defined any start value. We simply have created this variable, and the value it will take are going to be defined here. So we have fulfilled the stop loss condition. Now we simply connect it here. We do the same thing for the target price, and for the target price as well. We will take 110% of the ATR range. So whatever is the recent ATR range, we will be taking the 110. So we will multiply it by 1.1. Now this is our ATR. We take this at, okay, no issues if it has gone into A2. Let us create a variable. It will be target price entry, and it will be 1.1. So we got TPE here, and then the type conversion multiplication by 100. So we do A1 into A2 into A3. So now we have got the type conversion done. We got to create a variable TPP, target price pips. So we got it. Now we have done the calculation expressions type conversion as well. So for the day, the buy side is complete. So now if we connect it to the multiple action setup, then you will see that the buy side is ready. But then we want our algorithms to be symmetrical, and in tomorrow's session we will complete the sell side. So again we will cut it tomorrow, the flow, and then add the necessary calculation, and then we connect again. So for the day, that's it from my side. If any of you have any query or any idea to share, you can write it in the comment section, and I will be pretty much delighted to answer it back. See you tomorrow. Have an excellent time ahead. Goodbye.